Okay, welcome back, everyone. I'm honored to introduce the speakers for our first panel, Capital Market Challenges in Japan, the US, and the World. I will briefly introduce each of our panelists, but I encourage you to read their impressive bios in the conference booklet. Our first panelist is Toshiyuki MIYOSHI, the Vice Minister for International Affairs at Japan's Financial Services Agency, or FSA. He is a member of the Financial Stability Board, regularly representing the FSA in its meetings. He also participates in discussions at the International Organization of Securities Commissions and serves as Vice Chair of the OECD Corporate Governance Committee. Next to me, we have Anil Kashyap, the Stevens Distinguished Professor of Economics and Finance at the University of Chicago's Booth School of Business. He co-founded the U.S. Monetary Policy Forum and is a research associate at the National Bureau of Economic Research and a research fellow at the Center for Economic Policy Research. He's also a co-director of the Chicago Booth Kente Clark Center on Global Markets. Finally, we're also joined by Hiromi YAMAJI, Group CEO of Japan Exchange Group. Mr. Yamaji joined the group in 2013 as CEO of the Osaka Exchange and was appointed CEO of the Tokyo Stock Exchange in April 2021. Before joining the group, he served as Executive Vice President and Head of Global Investment Banking at Nomura Securities, also serving as CEO and Chairman of Nomura's overseas affiliates during his time there. The panelists gathered today have a wealth of expertise in global capital markets, so we're sure to have a fantastic discussion. Mr. MIYOSHI, the floor is yours.
Thank you, Professor Weinstein, for the kind introduction. Good afternoon, everyone. I'm Vice Minister for International Affairs at the FSA, Financial Services Agency, and was appointed just last Tuesday. It is a great honor to join this panel. And I thank the organizers for inviting me, even though it was actually my predecessor who was initially invited and whose photo was on the flyer. Many of the audience are here today, perhaps to listen to what Mr. Arizumi would say, as he is well known among the industry and the policy community. Although the flyer ended up becoming a sort of fake advertisement, this is all because of the personnel rotations that take place in Japan's civil service every year. It is never a type of online scam or a phishing message which the FSA is committed to fight against. In this session titled Capital Market Challenges in Japan, the US, and the World, I will be discussing the progress on the government's recent initiative to promote Japan as a leading asset management center. This initiative is a crucial part of the government's economic strategy, as Japan is faced with the challenge of sustaining economic growth in the context of the aging and shrinking population. It aims to achieve a virtuous cycle of economic growth and distribution through increased flow of household savings into productive investment. The fruit of such investments would lead to increased corporate value, which in turn contributes to economic growth of the Japanese economy, and the fruit of which will be distributed to households. That is the virtual cycle the government tried to create. Although many of the audience here may already know, I will first provide an outline of this initiative, which was put together in December 2023. So this initiative consists of the following 3 or 4 pillars. First, the initiative includes measures to promote steady asset building by households. The government developed a plan to double people's asset-based income and expanded the tax exemption regime for retail investors. Second, the corporate governance reform has been advanced. By so doing, the FSA aims to improve the functioning of Japan's capital markets, which would contribute to enhancing companies' longer-term corporate value. Third is a reform of Japan's asset management industry and patterns of asset ownership. Encouraging new entrants from Japan and abroad would stimulate the asset management sector, while asset owners are expected to work for the best interest of their beneficiaries. In addition, ensuring customer-oriented business operation is defined as a separate pillar in this slide. This concept initially formed part of the first pillar, but certainly applies to the third pillar as well. I guess my predecessor thought the same way and made it another pillar. So I borrowed a lot from my predecessor, but it is not a copycat. I got a permit from him. Okay, let me explain the progress made on the first pillar, promoting asset building by households. This slide shows the efforts by the FSA and the other government agencies to encourage investment by retail investors, including a legal provision to strengthen customer-oriented business operation by providers of financial services I mentioned earlier. Here, I will focus my explanation on NISA reform and efforts to advance people's financial literacy. At the heart of our approach is the Nippon Individual Savings Account, NISA, which is a tax-exempt scheme for capital gains and dividend income, the ministers mentioned just earlier. In January 2024, the government implemented a major overhaul of NISA, tripling the investment limit and making it permanent. This move has provided retail investors with clarity and confidence in the scheme. NISA now consists of two components. The accumulation segment, Tsumitate NISA, is designed for novice investors to promote long-term, diversified, and regular investments in simple, low-cost investment trusts. The other, growth segment, Seichō Waku, is tailored to more experienced investors, allowing investment in individual stocks and active funds. This is the English translation of the slide ministers used just earlier. So I've skipped the explanation, but it shows that the number of NISA accounts and the purchases under NISA accounts have increased quite a lot in recent years. So let me move on to the next slide. Alongside the reform of NISA, the FSA has advanced efforts on financial literacy, because retail investors must be well informed if they are to make an investment in financial products with risks. To this end, the Japan Financial Literacy and Education Corporation, JFLEC, was established in April last year. JFLEC is a private-public partnership with both sectors contributing financial and human resources. JFLEC produces standardized educational material and offers personal as well as group consultations. It also certifies financial professionals who demonstrate a commitment to acting in their clients' best interests. Let me move on to the second pillar of the initiative, which is corporate governance reform. Japan's drive for corporate governance reform dates back to the development of corporate governance code in 2015. The code has been adopted by a lot of companies and since then, leading to appointment of independent directors and establishment of nomination, enumeration, and committees at many listed companies. At the same time, some experts commented that the effects of corporate governance reform measures on corporate performance remains to be seen, such as improved performance in the use of capital. In view of these issues, the FSA, in close collaboration with the Tokyo Stock Exchange, has moved its focus of the reform from ensuring compliance with form to yielding substantive results. To this end, the FSA has published its action program for the reform for the recent 3 consecutive years, while the TSE has taken measures to encourage listed companies to enhance their performance. I will leave the presentation of a number of measures taken by the TSE to Mr. Yamaji. I just wanted to show you here that the TSE's efforts have started to bear fruit. These figures show that the listed companies that have responded to TSE's request for actions to strengthen efficiency have outperformed those who have not. They also show that the profitability of companies listed on the TSE still have rooms to improve, which is good news for global investors looking for opportunities to profit. So this shows the corporate governance reforms have bear fruits in the form of enhanced shareholder returns as well. Dividends and share buybacks have increased. Cross-shareholdings have steadily decreased due to accelerated corporate governance reforms. In addition to implementing and strengthening the corporate governance code, the FSA has recently amended its rules for financial disclosure to clarify the concept of shareholdings for pure investment purposes. This amendment is aimed at making it difficult to hold shares for cross-shareholding purposes while classifying the holding as that for pure investment purposes. I will now turn to the third pillar of the initiative, reform of the asset management sector and the pattern of asset ownership. The measures include asking major financial groups to set out their plans to strengthen their asset management business and creating special zone for those businesses. I will now focus on the last 3 measures shown here. Okay. One of the key measures to stimulate Japan's asset management industry is encouraging new entrants to the market. Several measures have been taken by both public and private sectors to encourage end users and asset owners to entrust their assets to emerging asset managers. The FSA submitted the bill for deregulation to this end. The bill to allow asset managers to outsource middle office and back office operations, which is the main cost factors when doing asset management business in Japan. The bill was passed by the National Diet, and the act took effect in May this year. This shows the asset owner principles which the government developed and published. It said that it is a set of common principles for asset owners. At the end of June this year, the number of asset owners that have adopted the principles amounts to 2019. So I took a little bit so long, but thank you for your attention.
So thank you, Miyoshi-san. So the next presenter is Anil Kashyap.
Okay, thank you, David, for having me. And for the audience, you probably know this is a difficult time for cross-border relations in the United States. The center here that Columbia runs is probably the last best hope for keeping interest in Japan alive. It's based on evidence and not ideology. So I'm pleased to speak here, and I hope you will support this venture going forward. I'm going to talk about the U.S. Treasury market, which is something that normally is described as the world's deepest, most liquid market. I think Secretary Bessent said that last week, but many people are starting to have doubts. So Jamie Dimon, who's probably the best known financial CEO in the United States, for months now has been saying, you're going to see a crack in the bond market, it's going to happen, and I tell this to my regulators, some of whom are in this room, and I'm telling you it's going to happen and you're going to panic. Now, that's not the kind of thing most CEOs would normally say to their regulator, and I want to try to explore why he might be worried, and I'm going to give you 3 reasons. So the first is that one big, beautiful bill that has just passed that has destroyed kind of fiscal discipline in the United States. We're now on a Japanese path to accumulating debt, and that's obviously going to put pressure on the market because issuance is going to soar. I've left out here the fact that you probably, or maybe it happened so fast you didn't notice it, but there was something called Section 899 of that act that was going to allow the U.S. to refuse to pay interest on Treasury securities that were held abroad. That got stripped out at the last minute, but it would have been unquestionable to believe that such a thing could have been even proposed, I'd say 2 years ago. The second is that since the start of this year, there's been changes in the way that the dollar has responded to interest rates. So you see in this chart that normally interest rates and the level of the dollar track each other quite well. If you look at this point here, you can see right around Liberation Day, all of a sudden, interest rates kind of level off and the dollar keeps plunging. So the United States is no longer trading like an advanced economy or a safe haven status. We could talk about the dollar if you like later in the presentation. I'm going to focus most of my remarks on a narrower point, which has to do with the plumbing of the Treasury market in the United States. And so the thesis I'm going to advance is that the marginal buyer of U.S. Treasury securities is no longer a buy and hold investor like a pension fund or insurance company. Instead, it's people with a very short horizon. And I'm going to describe where $1 trillion worth of treasuries now are sitting in a particular type of trade that hedge funds specialize in. It's a relative value convergence trade. And I want to explain why I think that trade means that the market is more fragile than you might be led to believe. So I'm going to do this in 4 steps. I'll start by describing what the trade actually is. Then I'll explain where it comes from, why there is such a trade. And then I'll show you like 2 minutes of evidence on my story for why I think that's the right way to describe the trade. And then I'll close by explaining why, once you accept that this is where the Treasury market is clearing, you should be worried. Okay, so this is a little bit technical, but you ought to be aware of it because if it blows up, it's going to be all over the news. And this is the trade that is dominant in the Treasury market these days. So the trade works as follows. Somebody wants to buy a Treasury security, but they don't want to put up all the money to buy the Treasury. They might buy $100 worth of Treasury, borrow $99 against it, and invest $1 of their own, okay? So that's the long end. These are hedge funds that are doing it, and hedge funds don't like naked bets on interest rates. So what are they doing on the other side of the market? They're selling short a futures position. So now they have a matched position, and the reason this trade is attractive is when the futures contract comes due, you just present the Treasury security that you already own. So it liquidates itself. And there's normally a tiny profit at doing this. And the reason you have to borrow 99 to borrow 100 is you have to increase the small difference in prices by a huge amount, say 50 or 99 times to make the money work. Okay, so that's what's happening here. And the last time this blew up was the first 2 weeks of COVID. And you can see that blue line here is the normal profit that you can make from this trade, and it's pretty small. It's on the order of, say, 15 to 20 basis points, so 1/10 to 0.2%. Of course, if you lever it up, you can make much, much more profits. And you can see that during the period right before the Fed and all the other central banks intervened, that thing spiked from 20 basis points to 120 basis points. Now, it retreated after the Fed bought everything in sight, but the fact that you could see this arbitrage collapse and become so dislocated is something to worry about. You can see also that the bid-ask spread on treasuries also exploded. That's the yellow line here. And to give you a sense, that's way unprecedented to see the treasury market become so illiquid and so not deep. Okay, so now why is this happening? Our answer is that this has nothing to do really with hedge funds waking up and deciding they want to do the trade, but instead the problem lies with what we call asset managers in this paper. So think of a bond fund that has a mandate to meet a benchmark. The benchmark is all bonds in the market, okay? And you want to outperform your benchmark. How do you outperform your benchmark? Well, if you could, what you'd like to do is not buy the government part of the bonds, just buy the corporate bonds. But you can't do that. You have something like $30 trillion to manage, and there's only something like $3 trillion of long-term corporate debt. So you got a problem then. You can't outperform the benchmark. If you just buy the government debt, you'll underperform it. You could do it that way. So what do these guys do? So think of this bond fund. What it might do is go ahead and buy corporate bonds. They'll buy all the long-term corporate bonds they can find. And they'll also buy any other short-term corporate debt because that comes with a premium. Now, that would cause a problem because you would be out of line with your benchmark. Okay, so how do you match your benchmark? Well, you buy futures contracts. And if you buy government futures contracts and you staple the futures contract together with the corporate debt, you now have something that's got the same duration or maturity as the benchmark, but it's going to earn this credit spread. So this is what's happening. There's $1 trillion of asset management doing this. I describe it as a bond fund here, but insurance companies and pension funds are doing a version of this. So that creates a problem because now you've got $30 trillion of Treasury futures being bought, and the Treasury market gets, the futures market is out of line. Who closes that gap? The hedge funds. So the hedge funds come in and go short the Treasury futures to close that back up, but the imbalance is enough to create a 20 basis point wedge. And that 20 basis point wedge, then, if they can lever it, becomes attractive to even a hedge fund. So what that means is that the duration risk, and then the hedge fund completes the deal by actually buying the physical treasury. So they're short the futures to help the asset managers. They're long a treasury so that they don't have any interest rate risk, and that's how the market is clearing now. Now, why do I think that this is powerful? Just because it's magnitude. So here's the first part of the story. You can see that the hedge funds there in the futures market are short just over $1 trillion. And you can see that their borrowing to buy the physical treasuries is almost equal and opposite sign. Here's the picture that shows you that the asset managers and the hedge funds are on opposite sides. So the blue line is, again, the hedge funds. The black line are the asset managers. And so that's how the market is operating. The way to think of this is that the asset managers have this problem. There's not enough long-term safe corporate debt that they can buy. So they're engaging in financial engineering. They're creating this futures contract along with the corporate debt, and that gets them what they want. The hedge funds step in to basically clear the market, but that means that all kinds of things can go wrong in the treasury market because there's at least 3 easy shocks to think of. Suppose the hedge funds need to come up with money and get out of this trade. They've levered it 99 to 1. The next person who steps in to buy the stuff isn't going to use that much leverage. So the price has to fall, the yields have to rise to make it attractive for somebody else to come in. So if they need cash, or the hedge fund loses money on some other trade, or the hedge fund's risk management team just says you got to step away from this, it's a problem. And a good example of all this is, who would have thought that Liberation Day, an announcement about tariffs, was going to destabilize the treasury market? But in fact, that's what you see. Here's the volatility in this difference between the spread. This is like the return on this trade, and you can see that the day the tariffs are announced, this thing closes down. Just the day that Trump chickens out, eat tacos, it goes back up and restores itself. But the point is, this is a time bomb, and I'm coming on Jamie Dimon's side. It's going to blow up at some point. If you want to read more about this, you can go to my webpage. We had a little op-ed in the Economist that makes it easy to read if you want to read that version. Thank you.
Thank you, Anil, for that uplifting analysis. Now I'd like to invite Hiromi Yamaji to take the floor.
Well, thank you very much for the kind introduction. I'm Hiromi YAMAJI. I'm Group CEO of Japan Exchange Group. It is an honor to be here. And for those who are visiting Japan this time, welcome to Japan. And welcome to the hot and humid city, Tokyo. Nowadays, average temperature of Tokyo in July and August is higher than that of Singapore, and humidity is higher than Bangkok, Thailand. That means that you should not come to Tokyo in July or August. But I really hope that you're going to enjoy this panel. JPX operates the 3 exchanges: Tokyo Stock Exchange for cash equity, Osaka Exchange for derivatives, and the Tokyo Commodity Exchange for energy futures, such as power futures. And today, I would like to share my view on the capital market challenges as a market operator. I think one of the challenges for capital markets around the world is fierce competition to attract global investment, global money. With fewer restrictions in many markets, investors can quickly move their portfolio when they are convinced that the timing is right and can move out quickly as well. Obviously, a market attractiveness is closely tied to the vibrancy of a country's economy. Nonetheless, if the market is illiquid, inaccessible, or not user-friendly, investors may not come in the first place and will leave quickly. Japan is no exception. As a market operator, JPX strives to provide a market that is fair and user-friendly and open to every type of investors from around the globe. Tokyo Stock Exchange has a market share of over 80% of the Japanese stock market and is actively traded by foreign investors, whose shares of the total trading value reached nearly 59%. Foreign shareholders own 32% of total listed shares. Osaka Exchange, which is the derivatives market, have 81.6% of global market share for Nikkei 225 futures. As for the future prospect, I believe the outlook for the Japanese capital market is brighter than before, especially after the US announced their tariff policies in April. Investors have been looking to diversify the risk away from US-focused strategies, and Japan has become one of the few candidates for this US plus one strategy. Since April, for the 16 consecutive weeks, foreign investors have been on net purchase position against the Japanese stocks, total of 5.5 trillion Japanese yen on balance. This momentum has been driven not by a single factor, but there are several positive factors at work. One factor is the global geopolitical tension that highlighted Japan's unique strategic position between the US and China. Another is the interest rate environment and its normalization. The most striking factor is the economic dynamics, which are moving out of deflation. Japanese companies are doing well, business is strong, and they are investing more in digitalization and automation. Not only the global investors, but also the domestic investors have noticed the momentum. Japanese retail investors are actively investing in Japan through the revamped NISA program, a tax exemption program that started in 2024, as Mr. MIYOSHI mentioned earlier. In the first 18 months, more than 27 trillion yen was invested, which is about 180 billion US dollars equivalent. The corporate governance reform is also generating significant excitement in the market because it suggests that Japanese companies will be on a growth trajectory. For the cash equity market, our mission is to provide a well-run platform that promotes constructive engagement for investors and listed companies. TSE has been committed to the corporate governance reform since 1999, so it is not a recent initiative. The reform gained momentum in 2013 when the late Prime Minister, Mr. Abe, took the office for the second time. Since then, his successors, including the current Prime Minister Ishiba, has strongly supported this initiative. Over the decade has passed, and there are clear signs of change, such as an increase in the number of independent board members. In 2014, before the introduction of the Corporate Governance Code, only 6.4% of the companies in the first section had 1/3 or more of independent board members. By 2025, this figure had increased to 99% of prime companies. However, the purpose of the reform is not merely to comply with numerical aspects, but also to implement changes in the substance, such as meaningful discussions at the board level, constructive dialogue with investors, and changes in the mindset that lead to sustainable growth. In 2022, TSE launched a series of projects. First, TSE introduced 3 new market segments, prime, standard, and growth, each with a clear concept. For example, prime market for global companies. Then, at the end of March 2023, TSE requested that prime and standard companies be conscious of the cost of capital and share price. This is not a request for companies to trade above book value or price-to-book ratio just 1. Management is to analyze the current capital efficiency at the board level and disclose plan to improve it through engagement with investors. Each company has different reasons for trading below book or struggling with their share price, and our intention was to encourage companies to understand their specific situation and develop unique solutions. 2 years have passed, and 92% of prime-listed companies have disclosed plans to improve their capital efficiency. Visible changes in the corporate activities have occurred. One example is the record high share buybacks, totaling 18 trillion yen or over 120 billion US dollars last year, and almost the same amount of dividend, which seemed to be growing even more this year. To be clear, we did not make a request for companies to increase their dividend or share buybacks. However, many companies are buying back shares to control the size of their large equity base. Also, the number of M&A deals is at a record high. Last year, there were 4,700 deals. In the first 6 months of this year, more than 2,500 deals have been made. The total was more than 31 trillion yen, which is about 210 billion US dollars equivalent, accounting for over 10% of the global M&A transactions. The momentum is continuing. So we are moving in the right direction. There is room for improvement, and that is precisely the reason why global investors see great opportunity. As a platform provider, we strive to bridge the gap between investors and companies by promoting engagement. We have provided 55 case studies based on feedback from over 300 global investors. Interestingly, the share price of the companies in these good case studies have outperformed others. We have also provided 10 examples of bad cases or misalignment. Companies' names are anonymous so as not to shame companies, and they are received well by both companies and investors. We are also revamping our growth market for startups. As Professor Kashyap foresaw in his book almost 20 years ago, the Japanese capital market has undergone changes, including reduction of cross-shareholdings and more retail investors joining the market. The market for corporate control is also growing. The gradual changes might not have been visible if you are looking at it every year. But after a decade, it is quite clear. Changes were steady, fundamentally changing the landscape. Forced changes might have been faster, but would have resulted in fierce rejection or superficial compliance. Sustainable growth can only come from continual and voluntary effort. The real change agents are investors and shareholders. That is why, whenever I speak with investors, I encourage them to actively engage and seek for hidden gems in the market. The corporate governance reform has just started. We are committed to continuing in our efforts and making our market more attractive. Thank you very much for your attention.
Thank you so much, Mr. Yamaji. So let's start our transition to the discussion. So I'm going to ask a few questions to get the of the panel, and then we're going to open it up to questions from the floor. So just think of your questions, write them down, and try to make them short. I want to start by, I'm going to start asking Anil a question, which is, and then I'm going to also expand that to the rest of the panel. What are the main vulnerabilities in U.S. Capital markets? And for the rest of the panel, I'm going to have you think about Japanese capital markets. And how might these conditions amplify risks in global capital markets through the various interconnections? So Anil?
Okay, so I think the optimistic case is that chart I showed with the dollar reflects the world deciding we'd been doubly overweighting dollar assets and now we're only going to overweight it by 100% or something, and that the adjustment will kind of level off and we'll go back to normal. I think there are a couple of threats to that view. One is just the policy uncertainty. The fact that they could propose that Section 899 is troubling. The fact that you've got the president lecturing the chairman of the Fed when the president can't even add up a basic budget is pretty threatening. And there's lots of fear in the United States that Fed independence is going to go away. If that was to happen, that would call for a rapid adjustment of interest rates. And then finally, just the fact that it doesn't seem like the U.S. has a clear plan for what its next steps of deregulation are. I think a lot of people, there's a story I read in the paper today, I think in the Financial Times, about why the deregulation of crypto and having that seep into the core of the banking system, which is now very much underway, is another threat. So I think the U.S. has got lots and lots of downside risks, a lot of them having to do with policy, and then a question of whether the institutional stability that's been there so long could vanish and be hard to get back.
So I'm going to now move to our two other panelists. So MIYOSHI-san, I realize you've been at the FSA for a long time, and you've just taken over. And what makes you worried at night about Japanese financial markets?
Thank you very much. So for the vulnerabilities, one thing we are increasingly worried about is that the kind of factors affecting Japan's financial markets comes from outside, with market participants whom we do not know well. For example, hedge funds and other funds outside of Japan, on which we do not have sufficient data to monitor, and even the kind of physical presence in Japan to visit or inspection, or asking them to come for interview or dialogue. So, but that is exactly, it seems that exactly happened last August when the stock market plunged really deeply even though it was just short-term sort of drip. So the stock market had recovered since then. So we are kind of lucky to have expected that kind of shock in a very short period of time. But it may not be that way the next time. So how to monitor the developments of the market participants affecting a lot on Japan's capital markets, but without any kind of data we have. That could be a challenge for us.
Yamaji-san, what keeps you up at night?
I think from a market operator's viewpoint, I think too much geopolitical tensions in the Asian basin would generate investment, fragmentation of investment flow. That means that reduces the kind of the inflow, capital inflow into Japan. That's going to be one of the kind of concern I have. And another concern is that because as you know, we have been suffering from deflation for more than 2 decades. We are getting out of deflation, that's for sure. However, under the deflationary environment, both corporate sector and the private sector just didn't have too much incentive to invest. That means that investment activities were stalled, and that was in the past. But that was the biggest challenge we had in the past.
Can I ask you a question, David?
Yep.
You've written a lot about debt sustainability in Japan, and I think it's great that the BOJ has finally defeated deflation, but do you worry about fiscal dominance and the idea that interest rates are going to have to be manipulated to make the debt work?
It's always hard to forecast this stuff, but you mean in Japan? Or
yeah,
are we going to?
Yeah.
I don't know. I think that it's been amazing how low interest rates have been in Japan, and certainly the fears of a crisis, have been around for many decades, and nothing has happened. I think we have a puzzle with Japan, why interest rates stayed as low as they did. Clearly that was instrumental to Japan surviving this. But I guess I'm not seeing a crisis develop imminently, so I'm relatively optimistic. That said, I kind of share both the other panelists' comment that, if something really bad happens in the United States, and I think exactly for the reasons you were suggesting, I do worry about that. It does keep me up at night. That can easily spill over to Japan. And we've seen kind of repeatedly, when tariffs are announced and U.S. policy becomes unpredictable, that has, major repercussions for the Japanese economy. I want to just switch gears a little bit and just talk about corporate governance reform, a topic that a lot of people have, so Anil has written on it, and obviously Yamaji-san's presentation was largely about this. And I was very impressed with the plots you showed about the increase in the number of independent directors. This is something that I know for many, many years Western economists were very upset about, and it's great to see that increase. What do you see as the most important reforms coming forward, and how would you measure, the most important things Japan is doing to enhance ROE and unwind cross-shareholdings?
I think we have made a very good progress in the past 10 years or so. And however, at the same time, those numerical aspects are not goal or the purpose of the corporate governance reform. We need to get into the substance. And the substance means that to achieve sustainable growth and the mid to long-term corporate value improvement through enhanced board discussions and also active engagement with the investors. So I think, those numerical targets are not, I think, appropriate in this time, because one size fits all type of approach would generate a kind of box ticking approach, and also to just trying to meet the minimum standard. That's not the purpose of the corporate governance reform. So I think, the market is the best discipline mechanism, I believe. And, ultimately, investors and shareholders would judge the progress. So I think that's the reason why we have been providing tools for companies and also investors to have a better engagement between them, like, as I said, analysis of good cases or bad cases kind of things. And from here, probably we will continue. I don't give you the specific kind of specific metrics or a milestone, but what we are committed is that we will continue to promote the corporate governance reform in Japan. And once a year, at least once a year, we make a review of our progress. And whenever we think we need to do something, we will do it. That's our commitment. Thank you very much.
Did you want to jump in? So let me ask you, Miyoshi-san. So I realize you're just new to your position, 6 days in, but I'm going to maybe ask a bit of an unfair question, which is kind of what regulatory reforms or initiatives do you consider most important for the FSA moving forward at this point?
Thank you so much. There are lots of various kind of policy issues we have at hand, including how to revitalize and restructure regional banks, and so we plans to put together sort of plans to strengthen regional finance and regional banks and regional finance by the end of this year, with a view to addressing the kind of structural challenges Japan's face, which is the aging population. And also, we have other kind of issues like how to advance on corporate governance reform, as Mr. Yamaji mentioned. We work together. But one thing I would say is that is important kind of in policy measures would be to how to respond to digitalization of finance, which is a kind of common themes for many jurisdictions. But it is particularly important for our country, again, in view of our aging and shrinking population. So we do need the increased productivity and efficiencies. So to that end, we are aiming for regulation and supervision, through which we could also promote the responsible use and innovation of digital finance, such as through clarifying the kind of expectation of regulators in the area of, for example, tokenization, stable coins, and something. Also, we need to address the risks associated with the digitalization, such as cybersecurity, third-party reliance, dependence on financial services, how to maintain operational resilience of financial services. So that is why, one of the reasons why we have kind of restructured internally the organization of our supervision. So in order to integrate such horizontal, cross-sectoral kind of sections with the individual financial sector supervision, like banking and insurance.
Thank you. Thank you very much.